Then Rofia Madzena joining us from the ENCA Money Desk to unpack it all. Rofia, I saw you doing a happy dance there when the governor was mentioning the 2.5%, the 25 basis points drop there. It was unexpected, was it?
It was unexpected, but it's good news for people like me because I think I pay a little bit less for things like my bond and things like that. But Annabel, yes, chief economist at Investec joins us now. It was unexpected, and I mean, this is obviously to accommodate a little bit of growth, to support some growth within the economy. But how much of a difference does this cut actually make?
Yes, hi. It was extremely unexpected, I think, and of course, it's a really good way to start the year, but of positive impact. I think, the concern certainly was a downward revision to their GDP growth forecast. But of course, answering your question, what does it really mean? And, 25 basis points may prove to be more of a confidence booster than it actually is in terms of an impact on economic growth. It'll have a small impact on economic growth, a marginal impact. It won't even be something that you would really notice too substantially. And, of course, it'll not occur in the near future either. It tends to occur a couple of quarters out. So, really to answer your question, I think it just makes people feel a bit more comfortable about starting the year. Perhaps it might lift our very negative consumer confidence reading of -7, slightly to a slightly better reading. But, honestly, when these small things incrementally start to grow, it does obviously start to change the environment as well. And perhaps one of those, the fact that we saw the private sector corporates invest quite heavily in the economy last year. And even though GDP growth is estimated by the SARB at 0.4 for 2019, we've probably got a figure of closer to 0.3. The bottom line is, if we are seeing a lot of fixed investment and, the growth of 16% and 11% in the second and third quarter of last year from the private corporate sectors, if you're seeing that type of growth rate, that also tends to build momentum and improve economic growth going forwards.
Yeah, and I'm glad you bring up the investment, and we'll touch on that a little bit later in the conversation. But I want to touch on what you say is very important, the growth. 2019 growth forecast by the SARB. It's actually the same as the World Bank, actually. They said 0.4%. Very, very scary thought there. And, of course, we can thank Eskom and the like for that kind of growth.
Absolutely. In the first quarter of last year, we remember certainly we had the cyclone impact that came through Mozambique and a bit into South Africa as well. But, of course, very heavy load shedding in Q1 19. The second quarter, we saw a big recovery as load shedding pulled back. The third quarter, there was a little bit. And the fourth quarter, heavy load shedding again. And it really just talks to the productive capacity of the economy. You can't see faster GDP growth if you don't produce more. And, of course, if you are having a situation where you're hamstrung by your productive input, by electricity, clearly you're going to be producing less, not more, every quarter. So very difficult times at Eskom. And, of course, substantial turnaround plans there. I was at the BUSA conference a couple of days ago, and it was very cheering to hear the President speaking there, President Ramaphosa, really saying that they're looking to start and get the private sector to supply onto the grid. And that includes households. People who've got solar panels on their roofs can start to put into the grid. Every little bit helps. Corporates who generate electricity, even large private producers. So, there are some positive things to look forward to this year.
Yeah, I was very surprised, though, when the governor said that they didn't factor load shedding into this particular interest rate decision. What are your thoughts on that?
I think it's got to the point where economic growth is just so weak that it's become so important. I look at it on a longer-term basis. In 2011, we had economic growth of about 3.3%. That was something we were used to. And really, it's fallen on a very sustained downward trend every year until last year it hit 0.4. If you look at a drop from 3.3 all the way down to 0.4, it really tells you next year might come out closer to 0%, if not actually negative for the whole year. That's a terrible situation to be in. You start to talk about certainly a stagnant economy, but even more so the risk of a recession, a supply-side recession, and that's where we're sitting at the moment. And I think this is very much a look towards economic growth. Inflation is subdued. It's at 3.6% in the last reading. And in fact, next year, we haven't obviously seen the latest assumptions, but when we look at the figures, certainly I don't think it's going to be much more than 4.5% for this year, and probably next year maybe even a downward revision. And all of that really feeds through to the point that perhaps the Reserve Bank really could cut interest rates, and in fact did. And instead of actually waiting and seeing if there's a little bit more data came through, I suppose they decided to do it right up front now.
Yeah, so their model does say that there could be 2 more interest rate cuts in the year, but there are some risks, the geopolitics, the trade tensions between US and China, and some domestic headwinds. What is the likelihood that we might see that?
I think you're quite right in highlighting that, because we are a small open economy. And, of course, what happens in global financial markets, happens in our financial markets. We get impacted by movements in the rand, by our bond market. So I think it's right to be cautious, because you can't say we absolutely definitely will have 2 more interest rate cuts this year, and then suddenly the entire environment changes. But it's very nice they're signalling cuts instead of hikes. And I think that, the important thing to understand is that their model builds in, will inflation be low enough in the future for us to allow 2 more or 1 more interest rate cuts? And their model clearly is showing that it could well be. So I think we can take comfort from the fact that if we don't see a negative year, if the global environment remains benign and perhaps improves, we've seen a first phase trade deal signed recently between the United States and China, and that is estimated to perhaps add maybe 0.3% onto global growth this year from what was previously expected. Those types of bits of good news tend to stabilize the environment, and perhaps, we may well, as we move through the year, be allowed to have those extra 2 cuts.
But then Moody's comes into the picture and may downgrade us. And I think it's March when they make their decision. We're going to hear the budget speech, and I'm assuming it's not going to be great news. So we might not be that lucky to get off easy with Moody's again. So that might have an impact, won't it?
Yes, and maybe that's why they decided to move before as opposed to after Moody's. But I think you're quite right. Moody's has basically said either you cut your expenditure projections, which means then that your debt and deficit projections will be cut, or obviously we're going to downgrade you, because Moody's, as we all know, looks at nothing else but your creditworthiness. How likely are you to repay your debt? And of course, finding yourself in an environment where your debt, your ability to repay your debts deemed to be decreasing because your debt is getting so much larger as a percentage of GDP. All they want to see is, are we going to lower that trajectory? Is it still going to be 73%, or are we going to maybe come to a point where it's maybe 65% or even close to 60% at the end point? If we see that, that may be enough on its own just to move us off that negative outlook and to place us firmly in the position of further interest rate cuts this year.
Yeah, but how likely is that, given what we're seeing? The ratings agencies often cite the fact that President Cyril Ramaphosa doesn't have all the power that he needs to steer the economy in the direction that it needs to go. So the likelihood of us reducing that debt to GDP ratio and possibly facing a more positive economic trajectory.
So I think very much depends on the political will in South Africa, as you mentioned. How likely is it? We've got it fairly evenly weighted that it will or won't occur. And of course, much is going to depend on how very much the leading political party in South Africa, certainly, but government itself wants to actually avoid a credit rating downgrade. And can they, and this is the important point, get a social compact? Can they get buy-in from the labour unions that, yes, you will get an increase, but it's not going to be above salary? It's not going to be above inflation for your salary and wages. And that's all that Moody's is really looking for, because that's the biggest component they've identified that's been blowing out the budget. And of course, debt, because government's been borrowing to pay these salaries and wages. It doesn't earn enough revenue to cover them fully. And will they be able to curtail these salary and wage increases? Sadly at the moment, CPI inflation, 3.6% is the last reading, is very, very low to go in for, salary and wage negotiations. But, we expect perhaps the December reading might be closer to 4%, and, obviously moving into January slightly above that. If they can settle on a 4% wage increase across the spectrum, perhaps that would count in our favour from a Moody's credit rating. Moody's just identifies that above salary and wage increases are the biggest component that has blown us out from an expenditure point of view, and by that they're obviously looking for us to curtail it. But a difficult question to answer, really, because, it might not even be enough, as you said.
Yeah. Let's talk about growth again, because it's a very important element of this, that 0.4 that we mentioned for 2019. And I think one of the biggest elements we have to consider here is the creation of jobs. That's all we talk about, the creation of jobs. And as long as growth is not at the same level as the rate that population is growing in, then we're not going to be able to create them. So, but what are the other elements that we need to consider in this regard?
Look, I think certainly, having a growth rate forecast of 0.8, 0.9 this year, and that's what the World Bank's looking at, 0.9, we're looking at 0.8, wholly insufficient for a population growth of above 1%. And, the other points we need to look at as well is inclusive growth. Even if you had perhaps 5% or 10% economic growth, if it's not really materially reducing unemployment in South Africa and pulling people into the formal economy, then, it's not the type of growth that we're really after. So those are key areas. Obviously, turning the environment around, turning the confidence, and certainly the investor climate around is really important. But, sorry to bring this up again, but I think also as well avoiding a credit rating downgrade is really important. Because if we get one, we're going to see a lot more volatility in our financial indicators. We already think our rand is very volatile, 16, 17, back down to 14, trying to get to 13. That's very negative for businesses. They can't plan. Businesses want stability. They don't want this difficult trading environment. But more importantly, you know, if you are looking at foreigners coming into South Africa, if a credit rating downgrade could well see a weaker rand, they might not want to invest in South Africa anymore, because translating the rands back into their hard currency or their currency that they have in their countries would actually reduce their returns. And it becomes a reduced return. We'd actually be shooting ourselves in the foot because we'd be getting less investment, not more investment. Dropping to speculative grade from sub-investment grade just means a lot more volatility and a lot less solid investment.
Yeah, one final quick one. You did mention a bit of good news in terms of an uptick in investment, that fixed investment you spoke about. Is that domestic? Are we seeing some foreign inflows coming in? What are those trends showing us?
So that's domestic fixed investment from private sector corporates already in South Africa, and it's really showing that the investment strike is non-existent in South Africa. You know, if you're getting plus 16% growth from the private sector and you're getting negative contraction from government, it's the government who's on an investment strike, not the private sector. And of course, you know, a lot of those investments do tend to be wind farms, renewable energy, and that's something positive for the future. You know, the bottom line is if we really improve our electricity supply capacity, that obviously does engender fast economic growth. But of course as well, you know, corporates wouldn't be investing if they didn't perceive there could be an uplift going forward. So hopefully we're in a slump now, and we really do see that this year delivers economic growth of close to 1%. And, you know, corporates obviously investing last year in the private sector in South Africa, also evincing the fact that, you know, they're obviously taking up on this investment drive of our president.
Investment drive, doing something right by President Ramaphosa. Annabel, many thanks for your time this afternoon.